Okay, hello everybody. Welcome to Korean Atlanta Mentorship. It is almost 3 a.m. I actually went to sleep early today, and I don't know if you ever had those moments where you wake up randomly at the middle of the night. Usually happens to me when the weather changes. I don't know why. And now it's going to be summer soon. So I figure, you know what? Before I try to go to sleep again, let's just crank out another study session of velocity banking. Almost 3 a.m. right now. And you all know the saying by Bruce Lee where he says, I don't fear the man who does 10,000 kicks once. I do fear the man who does one kick 10,000 times. And we're on our way to doing 10,000 videos of velocity banking over and over again because we're going to become masters at this, right? And so, what is velocity banking? All it is a debt payoff strategy using lines of credit as your main tool, right? So, if you really want to deconstruct it, it's just having no savings, like no savings, with the help of a line of credit. Okay, so few things that or two things we have to remember is that we always have this column here. Well, we actually first thing is we need a budget, right? So our budget is essentially our debt attack plan. We have our income, expenses, our savings, leftover savings, and in our expenses we have to list every single debt that we have, right? As you can see here, we have 5 debts, 2 credit cards, a student loan, auto loan, and a mortgage. Some of this might be unrealistic, right? Because who has a 20, I don't know what the average student loan is. Is it 30, 40,000? I've seen like as high as 200, $300,000 for like basket weaving. That's a ripoff. Um, personal mortgage, right? Like, 3% isn't normal these days anymore. It's 6%. But I remember when I got my mortgage, it was like 2.875 or something like that. And I've seen as low as 1%. I've seen that before. So pretty crazy. But I'm just making up these numbers. But hey, it's kind of like that. What was that Drew Carey show? Whose line is it anyway? Before he did The Price is Right, where they just kind of the points don't matter and you just make it all up. We're just doing that right now with our debts. So, so the whole point of this is to eliminate all of these debts, and the more debts that you eliminate, the more cash flow you get, and you just kind of move them to a line of credit. Yeah, so that's pretty much it. So budget, we did that. Now, to when we do the budget, or I'm sorry, the velocity banking side of the budget, we assume two things. Number one is that we assume that we don't make more money, and then number two, this is the most important part, we don't have any savings, right? This is very culturally ingrained in us that if we don't have any savings, then we're actually, we're in a bad position. And when in fact, it's actually the opposite. Savers are losers. That's kind of what Robert Kiyosaki, Rich Dad, says, right? And I've seen some of you in the comments who've been writing like, I totally wiped out my savings to pay off my debt, and I'm nervous, right? Again, I'm not giving you financial advice. I'm just telling you what other people have written because you got to take responsibility for your own decisions. Now, if that wasn't the right decision for you, don't take it. But I'm saying that this is what velocity banking is that it's essentially no savings with the help of a line of credit. Okay, now let's go ahead and do this. Copy some of these figures right here. Okay, now we have this thing called cash flow, which is income minus their expenses. So it looks very similar to savings, except that we're going to use our line of credit as our main operating account, and our goal from day one is to increase this number um, by making our line of credit as our main operating account. Okay, so what is a line of credit? All it is a financial tool where you can borrow money, pay back, use it over and over again. So if you have a credit card, that's a line of credit, but there's also other different types of lines of credit, like a personal or home equity line of credit. Okay, and I have all of them, right? The every type of line of credit has its own strengths and disadvantages. So, for example, a credit card, um, if you pay it off in full, they don't charge interest. Whereas with a personal line of credit, you borrow a penny or a dollar, they're going to charge you interest no matter what. So, again, every tool has its own advantages and disadvantages. Now, for the purpose of this demonstration, we're going to assume we have access to, let's say, a $30,000 home equity line of credit. So if you don't know what a home equity line of credit is, all it is like a credit card based on the value of your home. You're providing your home equity as collateral If you don't know what that means, just assume that if you have a lot of your mortgage paid off, the bank will lend about 80% of the difference between the value of your home and your paid off mortgage in the form of uh, kind of like a credit card or a line of credit, home equity line of credit, right? So let's assume for this example, because we're a homeowner, we have a $30,000 limit available for us, okay? And this is going to be essentially our main operating account going forward rather than our checking account. So the average American pays things at our checking account, and whatever is left over, it goes into savings. Velocity banking is we make sure we have no savings and all of our money is focused on paying off debt if we are on debt payoff mode, right? So now that we have written all of our debts, which one do we focus on, right? And one of the easiest ways to kind of determine which one to focus on is by using something called the cash flow index, right? I started to fall in love with it when once upon a time, this is about, I think 6 months ago, when somebody sent me their spreadsheet unsolicited and made over six figures and had 15 debts, and I was like, whoa, how do I figure out which debts to pay off? And it's like, oh, cash flow index, so easy, right? Like if I have to think too much about, I'm gonna pay this debt here because it's the highest interest rate, or this one has the highest payment, oh, this one has the lowest balance, too much thinking for me. Just give me a straight up formula of what to do, and that's the beauty of the cash flow index. So all it is just the balance of the debt. So here it's 5,000 divided by the payment, right? So 175. Okay, 175. And let's go ahead and do that for all the other ones. 18,000 divided by 585. This one is 20,000 divided by 217.05. This one is 23,000 divided by 447.87. And then this one is 225,000 divided by 948.61, right? So think of this as like a ranking system. You pay the lowest ones first, and then you pay the again, you pay them in order, right? Lowest first, highest last. So you can see the mortgage one has the biggest number, and then the student loan is the second biggest, and then the auto loan is the third, and then credit cards, so on and so forth. Again, if you want to look more into this, look at cash flow index. One of the ways you could kind of think about this is, okay, let's say I'm comparing two loans, auto loan, personal mortgage. Which one do I pay off first? Think about it from this way. If I pay $23,000, I get $447 back, okay, into my cash flow. If I pay $225,000, I only get $948 back. So which one gives you more bang for your buck? It's obviously this auto loan because it's only $23,000 and it's giving you half the cash flow of the mortgage, right? You get two of these loans. That's the cash flow of the mortgage, and with the mortgage, you got to pay $225 or $1,000 to get $948 back. Again, if you want more info, look into cash flow index. But basically, we're going to take these lowest ones here, these two credit cards, and then move them into that line of credit. So let's go ahead and move a 23,000. Okay, and so off the top of the bat, right? Because simply just by doing a debt transfer, we increase this cash flow 0, 0, and we went from an impressive 1,600 a month, right? 1,600 a month is impressive because if you look at statistics, the average American can't even afford a $400 a month emergency. We went from 1,600 to $2,380. Okay, day one, right? Because what's the actual strategy? The actual velocity banking strategy is you dump your entire paycheck into the line of credit, expenses out, and then your balance is going to go down about $2,000 every single month. Okay, all right. So let's go ahead and calculate this with Excel. And so we're going to do this, which is next month is previous month's balance minus plus previous month's interest minus this cash flow number, which is 2386.47. And then we calculate the interest by getting the average daily balance, average, multiplied by the interest rate, which is 0.1, and then you divide by 12, right? Okay, so let's go ahead and do that, and then copy and paste these formulas. And then as you can see, we scroll down by month 11, we've paid off this line of credit. So we paid off these 3 credit cards. So let me just put a milestone here, or not 3 credit cards, 2 credit cards. My bad. So 2 credit cards. Um, so let me just kind of do this. Wait, how many months was it? It's 3 a.m. right now. Sorry, folks. I'm getting sleepy. 11 months. So 11 months for 23K. Okay. All right. So now we have a student loan, we have an auto loan, and we have a personal mortgage. So we can see just from the cash flow index numbers that we got to pay off the auto loan first next, right? And the cash flow index, when it comes to loans, will actually change because unlike a credit card where the payment is usually proportional to the balance, a student loan or a loan in general is not, because that payment's fixed, right? So let's figure out what the balance is after 11 months. So what we do is we just go here, 23,000, okay? 23,000, 5 years, 6.3. And then after 11 months, we kind of figure out what the balance is. So 11's right here. 18 grand is month 12, right? So let me just go ahead and put that number right here. 18 grand. So let's figure out the new cash flow index, which is 18959.21. And then you can see that it's now a lower number. Now, if you look at the explanation on the Wealth Factory, which came up with the cash flow index, they'll tell you pay off anything below 50. So we could move this into the line of credit. Again, 18959.21. So let's go ahead and move this right here. And then I'm just going to go ahead and do that. So let's just do this. Okay. And now what's our new cash flow? Well, because we just paid off the auto loan, this goes to 0, and our new cash flow is 2,800. We're almost at 3,000. Isn't that amazing? So 2834. So let's go ahead and put this in our calculations. 2834.34. So 2834.34. Okay. So now let's go ahead and copy this, right? And now, so hold on. Okay. So now in total, it takes us 18 months to pay off the 2 credit cards and the auto loan. So 18 months. And so now what we gotta do is 23 plus 23, that's 46K. It's 46K. Oh my goodness, 46K. Okay, so 18 months for 46K. Now we tackle on the student loan. Okay, the student loan is not going to give us that much cash flow for paying it off because, again, we pay off. Well, let's take a look at what the actual balance is. 20,000, 10 years at 5.5% interest rate. And I actually had no idea that student loans were for 10 years until I relogged into the Sally Mae or Navient portal. I was like, whoa, it was 10 years. And I didn't just have one loan, I had like 3 different loans at 3 different interest rates. It's funny how that works. Okay, so let's just go back here. Whoopsie, not here. Figure out 18 months. What is the balance, right? And that'll be 17 grand. So 17 grand is the balance at this time. And we got to figure out that cash flow index number. So we're going to do it right here. Okay. And what's our new cash flow index? 81. So still above 50, still a high number. So I'm not sure if it's a good idea to put the entire thing into the line of credit. But let's just play around what we call the velocity banking calculator, right? And so one of the things that we can do is just put this in a plug and play, whether it makes sense to put this in a line of credit, the whole thing in a line of credit, or should we just move it into pieces into the line of credit, right? It's something we might consider, especially if we don't get a lot of cash flow for paying it off completely when you're moving into a low interest rate to a high interest rate line of credit, right? Low interest rate loan to literally a double high interest rate line of credit. But let's just go ahead and play around with this. So 20,000. What's the current balance? It's 17,652.94. 17,652.94. Interest rate is 5.5%. Term is 10 years and 217.05. And what is our income? Our income is $6,000. And our expenses is everything except for the loan we're trying to pay off. So it'll be 2948.61. It's these two right here. 2948.61. 2948.61, right? So now let's see what happens if we move the entire thing into the line of credit. I'll do that right here at 10%. And again, we pay it off in about half a year and we pay $500 in interest, but let's just do this where we move about only, instead of moving the whole thing into a line of credit, let's move into $6,000 pieces, right? 6000. You see, you save a little bit of interest. So it's not that big of a deal if you decide to move the whole thing in the line of credit, but you do save a little bit of money. Now, this doesn't matter here as compared to the 30-year mortgage, right? And I'll show you that. Like, you don't want to ever put a 30-year mortgage into a line of credit. Every time I do this exercise, kind of a big mistake. And again, before I actually get into it, you might wonder where I got this calculator from. Look up Renatus. I'm affiliated with them as an independent contractor marketer, meaning I sell their products, make a commission. So if you were interested in learning not only about velocity banking but real estate as well, that's what I do. In my quote spare time, I sell educational products because this is where I originally learned this from. All right, so now let's go ahead and so regardless of whether it's $6,000 or let me do this. We move the whole thing into the line of credit. You'll notice that the payoff time is exactly the same, half a year. So we'll just say 6 months to pay off the student loan. Okay. Oh, not 6 months. 18 plus 6, which is 24 months. That's 2 years. So 20 plus 46 is 66K. Okay. 66K. So now the thing that's left is that personal mortgage, okay? So $225,000 at 3%. Let's go ahead and put this in here, 225,000 at 30 years at 3%. And then now if we go in here and at 24 months, we kind of figure, well, that's just after 2 years. So we just go here. So we're at 215 after 24 months or 2 years, okay? So that's our current balance right now. All right, so we've done that, okay? We have done, so we now we just focus on the mortgage. Actually, let me do this. So now what's our cash flow? It's about 3,000. Now, one of the things I want to talk about is that a lot of people have misconceptions about 30-year mortgages. People don't understand one of the reasons, like they see this low interest rate and they think, oh, I don't pay that much interest, but you're actually paying 50% interest on a 30-year mortgage, right? 50% interest on a 30-year mortgage at 3%, right? And you have to understand the reason why there's so much interest is because when you have a very low payment, you have to understand that the payment is all based on two factors, interest and time, right? So when you have, let's say, like a 2-year term, this monthly payment will go up, which people think is a bad thing, but the interest is actually going to go down. So if I do 2 years, look how this turns to $9,000 a month, but look how little interest you pay. So people don't understand that the trade-off for that low payment is all that interest you do have to pay over time. Okay, so that's kind of the danger of the 30-year mortgage. And so we take a look here. Yes, this payment is not that big, but we got to get rid of it, right? So again, we just put this into a line of credit, or not all of it into a line of credit, because let me show you why. So again, that velocity banking calculator, let's go ahead and put in that information again. So what is our expenses now? 2,000, because again, it's everything except for the loan we're trying to pay off according to this calculator. So 2,000. So let's just go ahead and put it right here, 225,000. And then I'm going to put in this 215 information right here. Oopsie. Oh, looks kind of wonky. All right. So 3%, 30 years, and payment amount is 948.61. 948.61. And so one of the things you might hear on the internet, oh, just replace your mortgage with the line of credit 215052.06, right? And so the time is accelerated, right? 6.1 years, but take a look at how much interest um, you got to pay, 74 grand, okay? So not a good idea to again move this entire thing from a 3% loan into a 10% line of credit. But if we just do this where we pay it off in $6,000 chunks from the mortgage transfer to the line of credit, look at how much interest we save or we're not paying. 18 grand is the interest, okay? And 5 years, so it's even faster than moving the entire thing into a line of credit, right? It's the one thing that we have to be a little bit aware about. Okay. Don't, if somebody tells you, hey, just blindly move a mortgage into a line of credit and you got a 1% or 2% or 3% mortgage and you're moving into 10% line of credit, you might have to think about that, right? Do the math. Okay. So as you can see here, it's about a 5-year payoff. 5 years, and we're gonna pay $100,000 of interest, but okay, we're only paying 18 grand. All right, so whoop-de-doo. I think that whoever the lender is gonna be super happy that they're only gonna make 18 grand. Not. Anyways, so yeah. So one other thing I want to talk about is, some people might say, hey, um, instead of putting this entire, moving it into the line of credit, why don't we just make extra payments? And dude, that's totally okay, right? Like that's totally okay. The problem is with extra payments is that most people will never do that because uh, they can't. If they put their entire cash that they have left over into directly into a loan, they don't have control of that money. Whereas if you make your line of credit as your main operating account, so much easier to see how, because your line of credit is so flexible. Like you can borrow money whenever you want. You literally click a button on the bank's website and they give you like $10 or whatever, right? Whereas if you tie your money directly into the loan, right? You tie it in directly into the loan, overpay it, there's no flexibility there and you could never get it back. But if you could just do the same thing with the line of credit and you have control of your money, why wouldn't you want to? Right? Like, why not? All right. So that's kind of the idea. So let me go back here. So it's 5 years, 5 years. And now what we got to do here is 24 plus 5. So it's just 2. So 7 years, right? Because 24 is 2 years. You add 5 years to that. That's 7 years. So 7 years to pay off. How much is all of this, right? Let's calculate this. Well, I had a running tally, so it's 66 plus 225. So almost 300,000. Not bad. 200. So basically, it took us 7 years to pay off almost $300,000 of debt, right? So this includes our credit cards, this includes our student loans, this includes our auto loan and our mortgage. So we had 5 debts. It took us 7 years. And this is assuming that we're never going to increase our income. Obviously, we do want to increase our income because inflation and stuff. But let's say we never did it. Take us 7 years, home free. If we're 18 when we learned this, and I don't know if you're going to make $100,000 when you're 18, but let's say you showed the strategy to your family of how to pay off debt. Maybe by the time you're all in your mid late 20s, you'd all be debt free, and then you'd have like a debt free party and do unlike other people who have to go to work, you could make velocity banking spreadsheets and make money on YouTube like I'm doing and when you can't go to sleep at 3 a.m. All right, well, that's it, everybody. It's 3:04 a.m. literally right now. I probably need to go to sleep. But have a great day, everybody, and we'll speak next time.